cold. I had my first cold in like a year. It was awful. But back in the saddle again, feeling good. And it's time for another housing debrief. Already episode 7 for 2021. Come on in here, Alana Joe. This is Alana Joe. I'm going to adjust the camera so you can see my little ones. Let's see if I can do that. Oh, how's that? There you go. Better, huh? This is Alana Joe. She's ready for a solid weekend of soccer fun. Anything else you're going to do fun for this weekend, Alana?
We are going to Nana and Pappy's house for dinner.
We are going to Nana and Pappy's house for dinner tomorrow. You are correct. It should be fun. That's following your soccer game.
Mm-hmm.
Yeah, that'll be great. Next, let's bring in the Athena Rose Thomas. This is Athena Rose Thomas. She, a.k.a. Art. Anything to say to the masses?
Hi.
Hi. Do we have a game tonight, huh?
Oh, yeah.
And a party.
Yeah.
So we have a little soccer party. So I'm an assistant coach of her soccer team, and we have a little party after the soccer scrimmage because we're back. We're playing a little bit of soccer. It's a lot of fun. What's your position?
Probably center mid.
Center mid. Yes. She kind of anchors the offense a little bit, being that center mid. Pretty awesome.
Yeah, mostly center mid, but also forwards too.
Also forward too. She likes to score goals. Let's bring on the incredible Mason Edward Thomas. Mason Edward Thomas. Mason, you're going to have a fun weekend this weekend?
Yeah.
Yeah. What are you looking forward to?
Soccer.
Soccer. Do you see? This is what we're doing this weekend. Soccer. And then I don't know what we'll do Sunday because it won't be soccer. So tomorrow is a fun day filled with soccer. Can't wait for it. So we'll see you in a little bit.
Thank you.
That's it. That's the kids that are here right now. And then Mia will be home shortly. I'm adjusting this camera. There we go. Yes. All right. So let's go ahead and begin the housing debrief, episode number 7. And here we go. Here we are. Let's see. There we go. Let's get the show on the road. First, of course, I'd like to thank our incredible sponsor. That's right. He's my buddy and your buddy. It is Kevin Buddy. And Kevin Buddy deals with, of course, more than one kind of borrower and more than one kind of loan. And he deals with everything from full documentation to alternative doc loans, investor financing, even private money. So pretty much you need something, Kevin Buddy has got it. And he's got loads of experience too. He's been doing this since 1976. That was the centennial year. So he's been doing this for quite some time, very knowledgeable. He likes to follow the numbers and statistics and data like myself, and just a really cool guy. So Monarch Coast Financial, Kevin Buddy, contact him to help you as well. His number, 949-422-2075. That's 949-422-2075. Thanks again, Kevin. And our company is Reports on Housing, your local real estate snapshot. What we deliver is a housing report every other week and covering all of 5 Southern California counties. And pretty much we like to dive into what's going on and what should your expectations be of the marketplace today. So as a result, of course, we're not focusing on closed sales. That's talking about what the expectations were yesterday or the month before, or even a couple months ago. If you ever listen to Case Shiller, the Case Shiller Index, that's usually a couple months off, which is a reflection of pending sales that were placed into escrow the month or two prior to that as well. So we're really looking at the past. Instead, I want to focus on right now, what's going on today, the supply and demand. Supply being the available number of homes for sale right now, not a lot. And of course, demand is just a snapshot of the last 30 days worth of new escrow activity. So if that supply and demand gets us what I refer to as the expected market time, that's the market time. If you place your home on the market today, when are you going to open up escrow? So if it's a short number, which that's what we're dealing with across Southern California and the United States. When it's a short number expected market time, that means we're going extremely fast. There are some areas that are like a 10-day expected market time. I've even seen them in the single digits for some cities, which is absolutely ridiculous. So it's all about setting expectations, because you can't really refute data and charts and having a real sound economic housing model. You can't really refute that when I'm looking at all the numbers and data and chart and bringing all the macro issues into it, looking at the data and charts and statistics that go along with that. We're able to extrapolate what's going to happen going forward. And data and this report are a strength that gives you power to talk about really what's going on that you can't really refute. There's plenty out there. As a matter of fact, I Googled market, housing market on, I didn't even Google it, I did it on YouTube and saw what came up. Everybody's focusing on housing crash. I've already talked about how it's not going to be a housing crash, but that's what everybody is hanging their hats on, is housing crash. And that's what gets the most views. So, like I said, we have reports that dot all over Southern California. And I do want you to know that typically I don't do this. This report is not going to be, it's a live broadcast. It's the housing debrief. It doesn't mean that's the report that I'm actually delivering. We did that last week. It happened to be the report that we were delivering, but that's not atypical. Matter of fact, my next report is not going to be on luxury, but I'm going to talk about it today, the luxury housing market. So the last one that came out was a market shift. That came out for LA, Orange County, and San Diego. And San Bernardino and Riverside will get theirs this coming up Monday, a market shift. And I went over that last week as well. So you can kind of see the macro idea of what's going on, but I drilled down to the specifics in the county, when to expect more homes coming on the market. So, we also have introduced a couple of new things, more homes coming. Well, this is actually a new infographic that is a link at the bottom. At the bottom of every single one of our emails, that reports that's delivered to you, is a bunch of links. And this is a new feature. These are infographics. So there will be infographics for you to utilize in your marketing. You can slap them up on social media. You can send them to clients, all that good stuff. And there's a blank space at the bottom so that you could go ahead and add your own personal branding. And then we also, a new feature is we have these social media posts. So we have these social media posts, and they're done by county. There's different ones for each county. And that's also a new feature that we introduced. So look for those new features. There are links at the bottom, and we're just trying to make this report just filled with as much value and information as possible. So go to reportsonhousing.com and click on subscribe. And there, like I said, a bunch of links at the bottom, and it comes out every 2 weeks. It's $15 per month or $150 per year. And you get a month free if you utilize the coupon code HOT LUXURY, because that is what we're dealing with, a hot luxury market. So let's get into it. The luxury boom. And but first, of course, we have to get into SoCal housing. And man, we're just out of control. It's out of control fast. We are going way too fast right now for my liking as an economist. Anything that is double-digit growth, which is what we're getting right now in appreciation, is too much, too fast, and it all has to do with ultra low interest rates. We are speeding. We should get pulled over. The whole entire market across the United States, Southern California, your local county should be pulled over and should get a ticket, and let's bring down that speed. The only way that's going to happen is with lower rates, which are coming. So let's talk about the SoCal housing supply. And last week, we were at 15,955 homes. That was up 0.6%, and I was very encouraged, an extra 90 homes. But within the last week, and then compare that to last year. Last year we had 81% more homes in the market compared to today. And even last year at this time, it felt like there weren't enough homes on the market. Compare this to many, many years past, and it's just not a lot of homes. And today we're at 15,595. So we actually went down 2% in the last week drive me crazy. So there are more homes that are actually coming on the market right now, but we're placing them into escrow just as fast. So that's kind of been an issue, is just the velocity. We need those mortgage rates to continue to go up to discourage some people from actually standing in line and outbidding or creating a multiple offer bidding situation where these houses are going like auctions. So if you look at the active listing inventory and where it's at, it's just crazy low. I mean, ugh, seriously, it's just way too low. We haven't seen this before, anything like this. It's not just here, it's all across the United States. It's really been an issue. And the real culprit of this thing right now is there's not a lot of homeowners coming on right now because there's nothing to buy. It's kind of this syndrome that everybody's saying, well, I don't want to place my home on the market because there's not really anything to buy, even though there are definitely wonderful strategies to getting around that. So, and I even heard of another one that I hadn't heard in quite some time. They're called bridge loans, where you're able to actually go purchase something, get a bridge loan while you place your home on the market. It flies off the market, and you only need it for a couple months. So bridge loans are another thing. And then there's a contingency on waiting for to find a replacement home. So you could actually get somebody to purchase your property, but it's contingent on you finding a replacement home. And you can also rent back as well. So there's plenty of different strategies, but still, not everybody knows what these strategies are. So over the last 5-year average, the number of homes coming on the market compared to what's going on today, in January, we were down 14%. Missing 3,000 for sale signs. In February, we were down 9%, missing 2,087 for sale signs. That's 5,000 missing for sale signs in Southern California. Well, I just did another thing. I did March 1st to March 15th because it's been a while since March 15th. So now my data is going to look pretty good. And here is the issue. We're down 9%. We're down another 1,000 homes. So now we're down 6,000 homes all the way from the start of the year through mid-March. So I'm hoping that this picks up, even though we're getting a slight elevation in the number of homes coming on the market, which is normal for this time of year. We're still placing them into escrow just as fast. So that's kind of an issue. So Southern California, March 1st to March 15th, I want you to know what's happening in your neck of the woods. LA County is actually up 1%, or an extra 24 homes. Compared to the 5-year average. Orange County is down 11%, missing 217 homes. Riverside down 15%, missing 362 homes. And San Bernardino County down 18%, or missing 577 homes. And then there's San Diego County. San Diego County can't help themselves. They're missing 23% of all homes compared to the 5-year average, missing 577 homes as well. So they're just missing a truckload of houses. And let's talk about SoCal demand. Of course, it's nuts. There's nothing like it. My poor hairstylist, he keeps on writing these offers, and he found another one that was listed at $750, wrote an offer for $810,000, something like that, and it went for an extra $100,000. So this is the marketplace that we're dealing with. It's kind of silly. The only fix to this really at this point is going to be higher interest rates, which we will get. And interest rates are to blame. And Southern California demand, as you can see right here, this was last week, was at 19,747. It went up 4%, or up an additional 687 pending sales in a 2-week period of time. So it was beginning to elevate. And last year we were at 15,839, but we were starting our pandemic last year. So it's 20% less. We're down 3,909 fewer pending sales across all of Southern California. So today it's actually went down 84. It went down 0.4% compared to last week. I looked at the numbers. The only culprit for this are the lack of homes that are coming on the market, especially in San Bernardino and San Diego County. That is where we're missing quite a few, and they just need to start knocking on doors and say that there's a different strategy. You can actually place your home on the market, and we'll find someplace, and then we can go sell your house, or we could get a buyer in there that will wait for you to go find something. There's strategies for this, gosh darn it. And then we have this is what's happened to the interest rates This Thursday, it spiked up to 3.17%, which means that we're above 3 1/8 across the United States. This is the Freddie Mac primary mortgage market survey that's been going on for 50 years. And I put COVID-19 in there. The reason I did that is because COVID-19 is the whole entire reason why we're enjoying these extra low, ultra low interest rates. That is the only reason why we are down so low, and we got into the twos, and even at 3.17%, I'm going to tell you this is an absolutely exceptional mortgage rate, and it would have been a record had we not had the pandemic, even at 3.17%. So we need to see more lift in in interest rates. But I mentioned COVID-19, but they're starting to go up, and the biggest reason why interest rates are going up is because COVID-19 is starting to dissipate. And you can see it. I have a couple slides just to let you know the total doses distributed across the United States, 178 million vaccination doses. And if people have at least received one shot in the arm is 88 million. That comes out to 27%. And keep this in mind, 9% of the entire country has had COVID. So if you add 27 plus 9, we're getting up there to where we need to start being so that we could start to see the spread slow across the United States. So, and we're already starting to see that, especially in California. We're at 9.2% of all Californians have had it, only 2,570 per day for the last 7 days. And that is the lowest level since May 30th. So I bring up this so that you can understand that, don't know why I did that twice. You can see that we're unlocking California, which is good for the economy. We're going to get jobs back. Disneyland's going back online next month. That's an extra 10,000 jobs, plus all the other jobs that surround it. And there's other areas. There's San Diego. There's the SeaWorld, and there's Magic Mountain and Knott's Berry Farm. And you know what? More and more is coming online. And you can see that California was all burgundy. It was all purple. Now it's all red. And I'm here to tell you, LA and Orange County, probably this coming up Tuesday, are going to move to orange. And that means that even more people can go inside of restaurants. And it's just because the spread is really under control, and all of the other counties are moving in the right direction as well. That's good for the economy. So, and this is where I bring up LA and Orange County. So probably next week, everywhere else is improving. We're still going way too fast as far as the Southern California housing market is concerned. And if you look at it, this is where we are. On March 18th last week, 24-day expected market time for all of Southern California is just way too hot. And yes, that's probably somebody very important. But anyways, last year we were at 55 days. That is, gosh, more than double than where we are at today. And today we're at 24 days. So last week we were at 24 days. Today we're at 24 days. It just hasn't changed. So, boy, look at this. This is the expected market time. If I draw a line across, ugh. That's all I have to say is ugh. It's just way too low. The expected market time is at a point where I'm just not comfortable. I like a 40-day expected market time for all of Southern California. And I only like that during the spring, and then I like to get above 60. That's where it's just a slight seller's market from 60 to 90 days. You can see when we're this low, we're well below 60, which is why we have appreciation. And let's see. I just want to, geez, I don't know why somebody keeps on calling. I hope it's not that important, like people can't hear me. I think everybody can hear me. We're good. I'm going to have to make sure I remove that phone next time. But you can see what's happening. What's happening is this is 2012 to 2013. We've had major appreciation. Check it out. Major appreciation. And this looks very reminiscent. Did I say 2012, 2013? I meant 2020 to 2021. I keep doing that in some of my presentations, but 2020 to 2021, you can see we're spiking up, and this is the very beginning of 2021. And check this out. This is 2012 and 2013. Looks very similar, doesn't it? And that was the last time we were this low as far as the inventory. As a matter of fact, we're lower today, and you can see we spiked up. However, we had rising interest rates, is what we talked about last week, which is why we're going to get a shift in the market for the second half of 2021. And you're going to see that rate of appreciation will come down as interest rates rise. And that is where we are headed. But right now, it's just going up way too fast, about 1% per month. And it's like North Carolina be like $150,000, and Georgia be like $250,000, and California be like $700,000, and you get this shack. I mean, that's really what it feels like, is things are so hot that everything is selling. So, but let's get further into luxury, because luxury is absolutely surging. And if you look at the general housing market, you can see what's happening with closed sales. Yes, they're up 16% for all of Southern California. That's an extra 1,960 closed sales for all of Southern California for the month of January. For the month of February, 14,197 closed sales. That's up 13%, or an extra 1,591 closed sales for the month of February. So we're doing more in general, but not a ton more. You can see the green bars on the right-hand side. That was how our spring was pushed forward in summer. So you could see how there was an elevation in the number of closed sales. That's why this year, starting from this point on, we will not be able to compare year-over-year data, because it's going to look terrible at first. And then it's going to look like, uh-oh, what happened? Our market isn't as good as it was last year later on in the year. And that's because you can't compare this year to last year for the rest of the year. But anyways, Southern California closed sales, yeah, this is where it's at right now. This is where it was at last year for the months of January and February, and this is where it was at in 2019. So 20 was better, and 21's even better. You can see that. That's what always happens at the beginning of the year, and then spring comes and we start to see more closed sales. But let's talk about that luxury. Luxury closed sales. Check out that Himalaya on the right-hand side. That is luxury closed sales. And keep in mind, this is a different moving parameter for each of the different range for each of the different counties. LA and Orange County are 1,500,000 plus. It's the top 10% of all closed sales. And San Diego's at 1,250,000 plus. And then we have Riverside County at 800,000 plus, and then we have San Bernardino at 650,000 plus. I think San Diego, did I mention that? 1,250,000 plus. So you can see different, but when I add them all up, all the different luxury, this is what it looks like. And it is a Himalaya. We're far outstripping everything else that we're doing. And this is where January and February were. That other spike right after that is the month of March, and then it fell like a rock because we got into COVID. But you could see January and February of last year was a good year for luxury. As a matter of fact, it was outpacing many years for a January and February. But this year, look at where January and February are. So if you look at luxury closed sales for all of Southern California, we are looking at up 49%, or an extra 579 closed luxury sales in Southern California. And for the month of February, it's up 84%, or an extra 912 closed sales. So last year, and we hadn't even gone into this pandemic yet, last year for January and February, it was actually really rock solid January and February closed sales that we hadn't seen in several years. And this time around, this outstrips everything. So we're up 912, 84% for the month of February. This is huge. So I don't know why, we're going to repeat it one more time. Luxury imbalance. I'm here to show you this because I want you to really dive into this a little bit. We're going to dive into it because check it out. If you look at it overall, it's an extra 14%. I don't know why I painted that pink. I was just getting a little bit carried away, but that's more homes, right? But if you look at 0 to 500,000, that is the range that's slowly disappearing with how fast values are going up. And as a result, 12% off from last year for January and February. We've done 12% fewer closed sales in January and February. And for 5 to 750, we're looking at 22% more closed sales. But then as we ride towards the right-hand side, 750 to million, 48% more, million to 1.5 million, 49, then it's 51% more, 1.5 million to 2 million, then 2 to 4 million, 62% more, and then 4 million plus is 66% more. We had 332 closed sales above $4 million in all of Southern California. Last year for January and February, 200. And this isn't even where the market really starts to sing. It's just now going to start to sing in the months of March, April, May, and June. So this is where the rubber is really going to meet the road. But you can see luxury is far outpacing the lower ranges. And January or February closings in LA is up 57%, an extra 485 closed sales. That's above 1.5 million. Orange County, also above 1.5 million, is up 48%, or an extra 208 closed sales compared to last year. Riverside County is up 118%. When it says over 100%, that means it's double. So it's more than double where it was last year, and that's 800,000 plus. That's an extra 328. San Bernardino County is almost double, 97%, or an extra 232. And San Diego County is at 52%, or an extra 237. And San Bernardino County is at 650,000 plus, and San Diego County is at 1,250,000 plus. So you can see across the board, everybody's really surging. And Riverside and San Bernardino, the Inland Empire, they're outsurging everybody else. And that's where you can get a lot more home for the price. And it is just absolutely taking off right now. But remember, I want everybody to understand we are going into spring. This is the best time for luxury. It is the best time for luxury. It is when we have a peak in demand in all price ranges. So luxury peaks, and so does the rest of the market in the month of May, typically at the end of May. And so I'm telling everybody, especially in the luxury ranges, you need to place your home on the market during the springtime. You can't mess this thing up, because if you think back, I talked about it last week, there's going to be a market shift. As we have an elevation in the 10-year treasury and ultimately 30-year mortgages, as a result, the housing market is going to slow a bit, especially once we get towards the summer. And when we do that, we're going to get some volatility in the stock market as well when we have these interest rates going up as much as they are, because people are going to be changing their different equity positions because of the difference in interest rates. We've already started to see that in NASDAQ, and we're just beginning. We're just knocking on the door of these changes in interest rates. So go back to my Housing Debrief episode 6. You could rewatch it to find out what that housing shift is. And you can even subscribe to the latest housing report and get a housing shift. And that's basically what's going on. So I place my home on the market now during the spring if I was in luxury. So reportsonhousing.com, click on subscribe, and it's $15 per month or $150 per year. You get a month free if you utilize the coupon code HOTLUXURY. And I do have a referral program. So even if you're already a subscriber and you tell your buddy, hey, you need to subscribe to this housing report, and then your buddy says, hey, yeah, John Smith told me to subscribe to your housing report, we'll give you a free month for that referral. So we really appreciate the referrals. Keep them coming. So, and I'd like to thank Kevin Buddy, my buddy, and your buddy, Kevin Buddy at Monarch Coast Financial. He deals with everything from full documentation loans to private money loans, everything in between. He's loads and loads of experience. Has been doing this since 1976, and just a great guy. So give Kevin Buddy a call to help you help your clients. He can help you personally as well. 949-422-2075. That's 949-422-2075. Kevin Buddy at Monarch Coast Financial. So that's all I have for you. So everybody, enjoy your weekend. If you have any questions, put them in the comments. I'll be more than happy to answer them. But I do have a soccer game coming up, so it might not be until later or tomorrow morning. We'll see when I get to it, but I will get to it, I promise you. So go ahead and put your comments in there and be more than happy to take a look at them. I really appreciate you tuning in, and I hope you have a fantastic weekend. We will see you on the other side. Thank you so much.